Hi, welcome back to CBSE Board Economics. I am Saddam Hussain here. Under monetary policy, there are what exactly is monetary policy? We explained earlier. Once again, I'll explain you what exactly is monetary policy. Monetary policy is the central bank's money supply and credit control policy. The central bank tries to create credit in the economy and tries to control money supply. When there is excess demand or inflation in the economy, the central bank tries to control money supply and the central bank tries to control credit in the economy. When there is deflation, underemployment equilibrium, recession in the economy, the central bank tries to have more money supply in the economy, tries to expand the credit. Under monetary policy, there are two major instruments. One is quantitative instruments, one is qualitative instruments. What exactly is the difference between quantitative and qualitative instruments? Quantitative instruments deal with the amount of credit, whether there should be more credit in the economy or less credit. And what exactly is qualitative instruments? These deal with the direction of change. It means for what purpose the credit should be given. Whether the credit should be given to agriculture sector, industries, or for speculation. Under qualitative instruments, the first and the most important instrument is margin requirements. What exactly is margin requirement? Margin requirement means, we'll take an illustration to explain what exactly is margin requirements. Whenever the commercial banks give credit, we are supposed to keep some mortgage in terms of property, in terms of securities. So when you have a property worth 1 lakh, you might be getting a loan of 80,000. That means the margin is here 20%, or they give you a loan of 60,000, the margin is 40%. What exactly is margin requirement? Margin requirement is the difference between the value of the collateral security and the loan amount. The value of the collateral security and the loan amount. That's a margin requirement. If the value of the collateral security is, if the margin requirement imposed by the central bank is 40%, that means you are liable to get 60% of the value of your collateral security. How does it help to control credit in the economy? When there is excess demand or inflation in the economy, the central bank increases the margin requirement. When the margin requirement is increased, automatically you will be getting less loans. When people get less loans, obviously it discourages people to borrow more money. So credit creation of commercial banks will come down. The money supply in the economy will come down. As a result, aggregate demand in the economy will come down. The demand for goods and services will come down, and price of the commodities will come down. We can control inflation. The other way around, how does it help to control depression or recession in the economy, or when there is deficient demand or deflationary gap? The central bank wants to revive the economy, wants to increase the output, wants to increase the income of the people, wants to increase employment level, wants to take the economy from underemployment equilibrium to full employment equilibrium. What do they do to the margin requirement? They decrease the margin requirement. When they decrease the margin requirement, you'll be getting more money on your collateral security. So it will encourage people to borrow more money from the commercial banks. As a result, aggregate demand in the economy will go up, then output will go up. As a result of demand for goods and services, income of the people will go up, employment level will go up, national income will go up, and we can pull the economy from underemployment equilibrium to full employment equilibrium. I repeat once again, under qualitative instruments. The most important instrument is margin requirement. What exactly is margin requirement? Margin is the difference between the value of the collateral security and the loan amount. For example, if the margin requirement fixed by the central bank is 40%, you will be getting only 60% of the value of your collateral security. In case of excess demand, the central bank increases the margin requirement so that you get less money. AD will come down, output will come down, everything, prices will come down, we can control. In case of deficient demand, the central bank decreases the margin requirement. As a result, more money supply will be in the economy, the output will increase, employment will increase, income will increase, and the economy will be pulled up from the underemployment equilibrium to full employment. What exactly is written here? Qualitative instruments, margin requirements. A margin is the difference between the amount of the loan and the market value of the security offered by the borrower against this loan amount. Briefly, in case of excess demand and inflation, the central bank increases the margin to reduce aggregate demand. In case of deficient demand or deflation and recession, the central bank decreases margin to increase aggregate demand. That's all we have time for this small video. Till we meet next time, it's goodbye from Saddam Hussein. Work hard for your exams. Till we meet next time.